Over the past 12 months, silver is up 71.8%. Gold is up 29.6%. Silver has outperformed gold by 2.4 times. And it did that while crashing nearly 46% from its January high. The reason has nothing to do with interest rates. I know that's not what you've been told. The textbook says silver is gold with extra beta on real yield moves. Yields fall, silver runs. Yields rise, silver lags. That model worked in 2018. It worked in 2020. It worked in 2022. Right now, real yields are at their highest level since 2008. Silver doesn't care. By the end of this video, you'll know exactly why the rate model is broken, why silver's supply can't respond no matter what the Fed does, and what China's record import flip tells you about where this market is actually headed. If you're still treating silver as a rate-sensitive trade, you'll be wrong at every key inflection point. You'll miss moves that have nothing to do with your Fed calendar. Here's what the old model said. Silver is a monetary metal. It tracks gold, but it carries more industrial exposure, so it amplifies rate moves in both directions. When real yields fall, money flows into precious metals and silver outperforms. When real yields rise, both metals lag and silver lags harder. That was the framework, and it worked. For years, it worked cleanly. You could pull up a 10-year TIPS yield, see where gold was trading, and get a read on silver within a tight band. Here's the problem. In 2026, real yields have climbed since February. 1.8% at the low, 2.4% now. The highest since 2008. Under the old model, silver should be getting crushed. It's outperforming gold by 2.4 times. And yes, silver ran past $120 in January and lost nearly 30% in a single day. That was margin hikes and forced liquidation. Leveraged unwinding, not the Fed changing its mind. Either the data is wrong or the model is. The model is wrong. Here's what changed. Industrial users consumed 657.4 million ounces of silver in 2025. That's 58% of all global silver demand. More than half of everything the market consumes now goes into solar panels, EV charging systems, and AI data center infrastructure. When one category is 58% of your demand base, it's the driver, not a secondary factor, the driver. The old compass was calibrated for a metal where monetary demand drove the bus. That metal doesn't exist anymore. The compass still points. It just points somewhere else now. So why hasn't price fixed the supply side? Why 6 straight years of deficits? Let's go look at where silver actually comes from, because what we find there should make you uncomfortable. Here's something most silver commentary gets completely wrong. Silver isn't mined like gold. When gold prices run and there's a shortfall, gold companies deploy capital and build new mines. Price signals work the way that textbooks say they should. Roughly 70% of silver comes as a byproduct of copper mining, of lead mining, of zinc mining. The drilling decision doesn't belong to a silver company. It belongs to a copper company that happens to pull silver out of the ground when it's going after copper. Now here's what that means in practice. We've had 6 consecutive annual supply deficits, every year from 2021 through 2026. This year's is 46.3 million ounces, and that's the smallest of the 6. Add all 6 together, and the cumulative shortfall is about 762 million ounces. That is physical metal the market consumed and never replaced. 6 straight years of running on inventory drawdown. So why hasn't the price signal fixed it? 2 reasons. First, if you ever wanted to start a new primary silver mine tomorrow, the lead time is 5 to 10 years. Second, those capital expenditure decisions follow copper prices, not silver prices. Nobody is going to build a new copper mine to chase a silver price signal. The math doesn't work that way. You cannot drill your way out of a 6-year hole when the drilling decision belongs to a copper company. That's the structural lock. It's not a short-term imbalance. It's not something a rate cut resolves. The one mechanism that would normally refill that inventory, new production responding to price, is almost entirely independent of the silver price. A supply deficit only matters if demand holds. So let's look at who's actually buying silver right now. And what happens when the biggest buyers start trying to engineer silver out of their products? The silver demand didn't exist at this scale 10 years ago. Solar EV charging, AI data centers, silver-intensive technologies sitting inside of multi-year government infrastructure programs across the United States, Europe, and China. This isn't demand that shows up when the economy is strong and disappears when it's soft. Governments legislated it into existence, and it doesn't go away because the Fed holds rates at a certain level. Now here's the part most silver bulls will skip. At these prices, industry is fighting back. Solar manufacturers are thrifting, engineering silver out of every cell they can. Industrial demand actually fell 3% in 2025. It's forecast to fall another 3% this year. And the market is still in a deficit anyway. That's the whole point. Demand is being forced down to meet supply, because supply cannot come up to meet demand. Now look what happened to the physical market this year. In the first quarter of 2026, China posted a silver import record, about 1,626 tons in 3 months. Think about that. China used to be a net silver exporter. It shipped out roughly 5,000 tons in 2025. This year, it pulled in 1,626 tons in a single quarter. That's not a fund taking a position. That's not a macro trade. That is a structural repositioning. China's domestic industrial demand now exceeds China's domestic silver supply. And it has nothing to do with the Fed. China's solar build-out, its EV manufacturing, its data center infrastructure, all of it now consumes silver faster than China can produce it. Supply that can't grow, demand that's legislated in, and the world's largest supplier of physical metal turned into its largest buyer in a single quarter. That brings us to the real question. How can this get resolved? And if it can, how long does it actually take? There are two kinds of commodity rallies. The first is monetary, rate-driven. The Fed shifts policy. Real yields fall. Money flows into precious metals. Prices rise. Clean, logical, and completely reversible. The moment the Fed changes course, or even signals a change, the trade unwinds. The second kind is structural. A physical constraint drives it. Supply genuinely cannot meet demand. And that rally doesn't resolve until the physical market resolves it. The Fed doesn't have a lever for that. And everything you're hearing about silver right now treats this as the first type of rally. The gold-silver ratio is sitting at 66.9. Back in February, it was at 57. So for the last 6 months, gold has actually been beating silver. And the ratio traders will tell you that's just mean reversion doing its job. That's a monetary framework argument. It assumes both metals are responding to the same driver. But silver has an industrial demand floor that gold doesn't have. A rate pivot doesn't close a 762 million ounce physical deficit. It doesn't shorten a 5 to 10 year mine development timeline. It doesn't reverse China's structural shift from exporter to importer. A rate-driven rally can reverse the moment the Fed changes its mind. A shortage of a metal that industry cannot engineer out fast enough has to be resolved by the metal itself. For silver to resolve this deficit, you need one of two things. Either primary silver mining becomes economically viable at scale, and that takes years of capital deployment, or copper and zinc byproduct output ramps enough to fill the gap. Neither of those happens in 12 months. You opened this video asking why silver is beating gold by 2.4 times. Here's your answer. 6 consecutive annual deficits, 762 million ounces of cumulative drawdown, industrial demand still at 58% of total, even after 2 straight years of thrifting, and the single largest demand center on the planet, China, flipping from net exporter to record importer in a single quarter. You now know the setup. You know what's driving it. You know why rate policy can't fix it. Now the question is, how do you position around it? You now understand why silver's outperformance has nothing to do with the Fed. 6 consecutive years of physical deficit, byproduct supply that structurally cannot self-correct, and China flipping from net exporter to record importer. That's a parabolic case. And that's exactly the kind of story that makes traders feel like the position is already obvious. But knowing the structural argument isn't the same as knowing what price is actually doing right now, or when this story becomes a trade. Here's what understanding this information also doesn't give you. The truth about the direction of price. It gives you a narrative, and narratives matter. But price is what tells you whether the narrative is true or not. The measured move is a framework for understanding the direction of price. It tells you whether this bullish narrative is being confirmed by price or not. If you act on a story like this without that framework, you could be on the wrong side of a trade for days, weeks, or even months until price confirms it. That framework is what I teach. The traders in my community don't chase bullish narratives. They know what price has to do to confirm the story. And until it does, until price structure supports it, they're not in a trade just because the narrative is compelling. They wait for the setup. They have a process for knowing when it's there. That's the process I teach every day at eMiniaddict.com.